What if the smartest investors in the world are quietly leaving the stock market right now? While millions of ordinary people continue buying stocks, some billionaires, hedge funds, and institutional investors are doing something very different. They're increasing cash, buying gold, reducing risk, and preparing for something big. So the question is, what do they know that most people don't? For the past few years, the stock market has looked unstoppable. AI stocks exploded higher. Tech companies reached historic valuations. And social media convinced millions of people that stocks only go up. But beneath the surface, warning signs are starting to appear. Today, we'll explore why smart money may be leaving stocks, what risks investors are worried about, and whether another major crash could be coming. Smart money refers to experienced investors with massive amounts of capital. This includes hedge funds, billionaires, institutional investors, and large investment firms. These investors often move before the public notices danger, because they focus on long-term risk, not hype. And recently, many of them have become much more cautious. Some famous investors are holding record amounts of cash. Others are reducing positions in expensive technology stocks. Why? Because they believe the market may be overheated, especially in AI-related companies. Many stocks have risen so fast that valuations are starting to look disconnected from reality, and history shows that extreme excitement often creates dangerous bubbles. There are several reasons why investors are becoming nervous. First, interest rates. For years, cheap money helped push stocks higher. But now borrowing money is much more expensive. That hurts businesses, consumers, and the economy. Second, massive debt. The United States now has enormous national debt. Corporate debt is also rising rapidly. If the economy slows down, many companies could struggle financially. Third, AI hype. Right now, AI is driving much of the market excitement. Some companies are gaining billions in value almost overnight. But critics warn this may look similar to the dot-com bubble before the 2000 crash. Back then, investors believed internet companies would change the world. And they were right. But many stocks still collapsed because expectations became unrealistic. And finally, fear of recession. Higher prices, layoffs, and weaker consumer spending are making many analysts worried about economic slowdown. If earnings begin falling while stock prices remain extremely high, panic can spread very quickly. So if smart money is leaving stocks, where is it going? Some investors are moving into cash, because cash becomes attractive when interest rates are high. Others are buying gold and other safe haven assets. Some are investing in government bonds. And a growing number are diversifying internationally instead of relying only on U.S. tech stocks. The goal is simple: protect wealth before uncertainty grows worse. That doesn't necessarily mean a crash will happen tomorrow. But it does mean experienced investors are preparing for volatility. Because they understand one important lesson: markets can change direction very fast. Nobody can predict the future perfectly. The market could continue rising for months, or even years. But history shows that bubbles eventually end. And when greed becomes extreme, smart money usually becomes careful. That's why many big investors are quietly reducing risk while public excitement remains high. The real danger is not fear. The real danger is believing the market can never fall again. Because every major crash in history started with confidence, right before panic took over. If you enjoyed this video, subscribe for more content about investing, economics, AI, and the future of global markets.